Well, the crisis has rolled into a second week. And of course, right now everyone's talking about oil prices, energy prices, but the overall theme really is around inflation. And that's why this week is particularly important. We have the CPI and core PCE price index releases coming out over the coming days. Of course, we're probably not going to see much of the recent crisis in Iran actually reflected in those inflation numbers, but it does give us the opportunity to really focus in on what inflation could look like and the potential implications for the likes of the US dollars and US equities going forward. So here's the breakdown in terms of market expectations for this release. And as we can see, it's all relatively calm. We can see the CPI numbers expected to drop to 0.2 for the core figure on the month and up to 0.3 for the monthly on the headline number. Overall, that takes us pretty much nowhere. 2.5 to remain on the core, 2.4 to remain on the headline number. Then we look at the core PCE price index expected to decline for the monthly figure down to 0.3%. So all relatively orderly there. And the 3% figure for the year-on-year number expected to remain in play. Notably, we do have the March inflation expectations figure for Michigan. That's expected to tick up to 3.4%. And then we have the near-term inflation expectations figure, which is expected to surge from 3.4 to 3.9%. So really, this does highlight the fact that people think that we're going to see higher inflation over the near term, but you look further out and those expectations fall quite dramatically. So the question mark really is how long this surge in terms of energy prices is going to last and the impact on inflation, whether it's going to be a lasting impact, whether it's going to be the kind of thing that the Federal Reserve can just look through, or whether it's something that's going to permeate throughout the US economy and global economy and ultimately lead to a fresh bout of inflation that comes through businesses and onto the consumer, and ultimately where it started probably becomes less relevant. As long as we see a new surge of higher inflation expectations, it's the kind of thing that we could see the Federal Reserve have to do something about. Here's the breakdown in terms of your headline CPI versus core PCE. And notably, we can see that divergence, that 3% figure for the PCE number coming in the face of a decline in terms of the CPI number coming down towards target. So it does really raise the question of what the Federal Reserve really care about when it comes to the core PCE, which everyone always says that's the Fed's favored metric. But then the CPI number, where ultimately, remember, the energy price gains we're seeing at the moment are, of course, focused on energy markets for the time being. And of course, that would be stripped out under the core metrics. And so it's a question mark of whether we just see the secondary effects of higher inflation coming into play. But certainly there's going to be a focus on the commentary coming out from different Fed members as we move forward, because if they see higher inflation, do they care about it if it's not in the core, right? Is it just something that they want to really control the narrative around the things that they can impact? Higher or lower interest rates aren't necessarily going to lift or cut energy prices. Same with food. And that's why a lot of the time they focus more on the core. But certainly against the backdrop of rising inflation, that doesn't necessarily provide the basis for a fresh bout of sort of significant easing, albeit you then look at the potential impact on the US economy and say, okay, are we seeing significant demand destruction through higher prices? So let's say suddenly you're paying a huge amount more at the pump, you're paying higher energy bills and the like. People therefore have less disposable income to spend. They go out, they spend less, the GDP numbers come in weaker. That's when you could potentially see the Federal Reserve say, okay, we're going to overlook what we can't control. And that is essentially the outside factors in terms of a multi-month surge in terms of energy prices that ultimately normalizes, or perhaps not. But what we can control is what's happening in terms of the outlook for the US economy. And it's suffering right now, so we need to do something. So there is that narrative. Right now, I don't necessarily think that narrative is going to play out as the sort of base case scenario. As we can see here, energy prices, of course, can play a pivotal role in terms of driving CPI. You've seen it in the past here with this example from Bloomberg. But you can see also that in sort of relatively normal times, if you look at the section on the right, energy plays a relatively small role when it comes to the sort of wider breakdown in terms of inflation. You can see exactly here the percentage weighting for energy within inflation. You can see 3.5% of the overall CPI number comes from gasoline prices, 2.5% from electricity. And what I thought was interesting here is we also see a breakdown in terms of different elements that may not necessarily be direct, but will give you a indirect impact of higher energy prices. And this, of course, could become more prominent as we move forward, because the Straits of Hormuz also sees the flow of much of the world's fertilizers and chemicals going through it. If we don't see those fertilizers, then certain crops that need it at this point in the year won't receive it. Then they could potentially down the line see failed crops or poor harvests, and that could raise the price of food. So food prices, new vehicles, household furnishings, apparel, different areas that the percentages are significantly higher and certainly add up to a much higher percentage. So down the line, we could see higher implications and wider implications if we see energy prices remain elevated and if we see the Straits of Hormuz closed for an extended period of time. So one thing here is that we've seen that the Fed have in the past noted that for each $10 rise in crude, you see the potential for 0.2% added onto the CPI figure. That means that at current levels, we could be heading towards your sort of 3.3. Of course, as you can see here, the spike as we began this week took us up to the levels of sort of 120 on WTI. That would be consistent with a return to sort of 3.5% inflation. Those figures aren't like huge, right? We're not talking about double figure inflation again, but they are big enough to think this is going to hold back the Federal Reserve from doing anything. Remember, this is headline CPI, so the core readings will not necessarily be impacted to the same degree, although you would see those secondary effects coming into play and impacting the cores. But yeah, of course, inflation can be driven by energy, but there's a number of factors coming into it. And I would say the length of time that we see energy prices elevated will be the key component. I mean, we could see WTI go to $200 a barrel, but if it returns back down to 70 within the space of 2 weeks, the impact's not necessarily going to be that big for the annual inflation figure. You might see a couple of outlier months. However, if you see it rise to say 130 and stay there for 6 months, 8 months, that's going to be a much more tangible impact when it comes to inflation. And that's the kind of thing that's going to drive the sort of wider year-on-year metrics up to sort of significant levels. So what this doesn't outline in terms of, $10 rise in terms of crude could lead to 0.2% of CPI. What it doesn't account for is how long it remains at that level. And if it's a short period of time, then it's not necessarily going to be as consequential. The caveat to this is, of course, over the course of the weekend, we did see the attacking, I think it was from Israel, of some of the refineries and the oil facilities in Iran. Israel care less about this than the US. I think the US and Donald Trump has certainly been aware of the impact of higher energy prices against his popularity in the US. And if he drives the likes of oil and gas prices higher and the price at the pump at higher and inflation higher ahead of the midterms, that's going to spell trouble for him. So I don't necessarily think that this is something that the US were too keen on. I might be wrong, but there's talk of potential falling out between the two sides over this, because the decision to take out Iranian facilities means down the line they're probably not going to get it back online for quite some time. So you're talking about supply destruction for the longer term on top of what's happening in the Middle East at the moment. The initial spike we saw in terms of oil prices came around those attacks on Iranian oil facilities on the weekend, but the pullback we've seen since really talks to the potential for the G7 to release some of their strategic petroleum reserves. That could provide short-term reprieve, not long-term. So the longer this goes on for, the less that sort of manages to equalize markets and oil prices. So certainly oil is going to be absolutely key as we go forward in terms of driving inflation expectations. You can see here in terms of the trajectory of WTI, which is in the sort of orangey line, which has been sort of surging upwards more recently, and in actual fact doesn't really account for the rise that we're seeing right now. Not sure why, but in any case, you can see on the left-hand side exactly the price. This is around 70 odd. So I think I've got it in the weekly time frame. That's why it's not taking it in. So, of course, it's sharply higher from here. And we can see that generally you do have that relatively close correlation. I've got the 3-month annualized, which really highlights the fact that if you're looking at just a year-on-year inflation metric, it's not going to really track the trajectory of inflation to any decent degree because it's sort of too lagging in nature, and it takes a while for short-term impacts to be playing into the wider number. Whereas the 3-month annualized, sort of, you can see a pretty close correlation between the two. So if we do see inflation, if we see energy prices continue to rise and stay high for months at a time, that is the kind of thing that could really drive inflation higher. And of course, that impacts sentiment for what the Federal Reserve is going to do, and sentiment for, of course, in turn, the likes of the US dollar, which we've got the dollar index this time around in the orange line, alongside the inflation rate, that 3-month annualized inflation rate. And you can see that generally, higher inflation should mean a higher dollar. Weak inflation should mean a weaker dollar. We've seen the possibility of a surge in terms of inflation, and that's part of the reason why we're seeing this strong dollar coming into play. And we'll sort of touch on that in a sec. And you can see that the expectation of higher inflation impacts the bond market, which you can see here in terms of the US 2-year yield moving sharply higher over the course of this month thus far. And so we've seen the US dollar go with it. So if you want to see a good proxy for exactly how people think that the Federal Reserve are going to react to what's happening right now in the Middle East and in terms of energy prices, look at the 2-year yield, and that should give you a good idea of exactly where the US dollar is going to go in turn. Market expectations for December currently easing off of the idea that we're going to see 2, 3, 4 rate cuts this year. Now it's a case of, well, will we even see one? And certainly the commentary coming out from some of these different Fed members will certainly be key, as I alluded to, because inflation, whilst we see it this week, might not necessarily look too troublesome, but it could look very troublesome if we fast forward a couple of months and we're still seeing oil prices above $100 a barrel. That's the kind of thing that lifts inflation. Short-term spikes in terms of inflation pressures can lead to elevated wider inflation metrics like the year-on-year figure. You can see it in terms of the UK, where we saw the April figure from last year essentially keep UK CPI above 3% for pretty much the entirety of the year. And then we're finally coming back down now with base effects sort of kicking that number out. And soon enough, we'll see a collapse in terms of that headline CPI number, well, just in time for energy prices to soar. But so certainly short-term spikes in terms of inflation can certainly have a tangible impact on the year-on-year metrics for the entire year ahead. And we've already seen some hesitancy from a number of Fed members when it comes to cutting rates further from here. So there's a chance that we see a more patient approach from the Fed going forward, even if we do see a change at the top of the pile in May when Kevin Walsh is supposed to be coming into play. So let's look at the charts right now. Like I said, we have got this relationship here in terms of the 2-year yield and the US dollar, but it goes further than that. So let's look at a number of things all smashed onto one chart, and we can see some correlations in play. So we've got that 2-year yield, which is, there it is, the blue line. We've got the US dollar index, which is the candles. We've got WTI, which is the green line. And then we've got the US S&P 500, which is the orange line, yellow line, depending on how colorblind you are. So essentially what we can see here is, and bear in mind that S&P 500 is inverted. Essentially what you can see here is very close correlation between all of these markets. So what does this tell us? Well, it tells us that inflation, as we take things out, inflation, here we go, let's hide this. There we go. Inflation's here. Sorry, oil prices are here. So oil prices, we've seen this massive spike of late. That lifts inflation expectations and lifts expected rates from the Federal Reserve. So less easing from the Fed expected, and that is reflected in the 2-year yield. So as we can see here, we've got that correlation. Sometimes you see sort of swings up and down, but the direction of travel certainly has been in the same direction of late, as people are now fearful that the rise in terms of oil will give way to a more hesitant and cautious approach from the Federal Reserve. That in turn then lifts the dollar. So there's the US dollar index, and that's tracking perfectly really with that 2-year yield. So oil leads expectations of where rates are going to go, leads the US dollar. And then we've got the value of S&P 500, which is inverted, because if we see the expectation of higher inflation, if we see expectation of a more cautious approach from the Federal Reserve, then it leads us to a position where we see people cautious about the direction of travel for US equities, which, like I said, is inverted. So this is what it looks like at the moment. So we're seeing US stocks rolling over as a result. So all of that is to say that if we see a continuation of the rise in terms of oil prices, we would expect to see a continuation of the strength for two-year yields, for the likes of the US dollar, and weakness for equity markets. Now, of course, we're now coming into what this video is about, and that is the inflation metrics coming out in terms of CPI, in terms of the core PCE. I would say that essentially, if they come in weak, markets will essentially disregard that, because they'll think, well, it doesn't actually account for what's happening in the real world right now in terms of energy prices. The flip side of it is, if it comes in hot, then people think, damn, it's coming in hot, and we haven't even started to price in what's happening in the energy markets. The caveat to all of this is we could suddenly, and I don't necessarily know that this is about to happen, we could suddenly see Trump say, all right, okay, we've achieved our objectives, all good, we're just going to move out now, and we've sort of smashed up enough of the Iranian regime to think that they've been set back by X amount of time. And people could hope that suddenly we get some sort of semblance of normality within the next, period of time. But of course, there's been a huge amount of destruction, so I don't necessarily know it's going to be a dramatic, swift return to normality. But that is the caveat. Well, of course, all of these moves can reverse if that happens. If we don't see that, and we see it continuing to get worse, which it appears to be the case, that every day it gets worse, we're not seeing any improvement or any talk of a deal, then that points towards a possibility of more of the same, really. So higher energy prices would therefore lead us into a position where we potentially see higher US dollar and weaker equity markets. So here's the dollar at the moment. If we want to put the chart for WTI at the moment, you can see here that we've seen these sort of surges in terms of oil prices, and by and large, during that period, we've seen equities holding up relatively well. The US dollar holding up relatively well, and therefore we're now seeing this pullback that comes after an attempted break higher. So essentially, you saw this initial break higher in terms of oil prices, and we saw the dollar follow suit. Then we saw this continuation turning into a break higher, but we didn't necessarily see that for the US dollar. But now you're seeing it here. We're seeing breaking up through that resistance, then pulling back, then breaking up into a new high, now pulling back alongside oil prices. So if we see oil push higher once again, I would expect a rally up through resistance, through that sort of $100 mark here for WTI. But then in terms of the price for the dollar index, so it's 111 on WTI, dollar index 100. So essentially, a spike in terms of oil leads us into that next leg higher for the US dollar, or certainly that's how it looks. In terms of equity markets, let's put US crude on here. And so we can see here, let's invert crude this time around. So we're just focusing on exactly what's happening in terms of equity markets. So we can see here that gradually we had been sort of losing ground in oil, and that's beneficial for equity markets. And then we see this sort of collapse coming into play at the beginning of this month. And whilst we have seen some weakness in terms of equity markets, are we going to see more? I think so. If we see the likes of crude really declining in a dramatic fashion once again, then you would expect to see equity markets falling over once again. Now, if we see here, what's interesting really is that we've gone from, say, sort of $64 a barrel to near enough 100 essentially. So in percentage terms, you're talking about something like an 80% gain. I mean, what's the gain on? I don't really know if, this is going to be in, here we go. So let's see it in terms of the gains that we've seen on a percentage basis here. So that's where the jump happened. So we're currently up, so 44%. Then if you look at the likes of the S&P 500, it's declined. Let's see, where were you kicking off? It's roughly around there, like 2 and a bit percent. So it has held up very well over the course of this period. And so essentially what you're looking at here is, yes, there's a possibility of downside, but at the moment, markets aren't really pricing it in as a major crash. And that's probably because people are thinking with a relatively sort of long-term view and thinking this is, probably going to get resolved soon enough. It shouldn't be too detrimental. But certainly if we do see another sharp rally in terms of oil prices, I think there's a good chance that we do see equity markets falling off it at a greater degree than we're seeing at the moment. But I would say it's holding up relatively well. If you look at this daily time frame, yeah, we've pulled back, but we pulled back into levels we've seen in sort of December time, finding support in the 76.4 fib, which is 96.20, which is 66.20, and now starting to find some support. But certainly I think things are really being driven by oil at the moment. If we do see a continuation of the rally that we're seeing in terms of oil, it provides the basis for further upside for the US dollar and further weakness in terms of the S&P 500. And if you want to see how expectations around the Federal Reserve easing are coming into play, look at that 2-year yield. Certainly I think it's an interesting one to say, how high will the 2-year yield go? Because, we've already now currently got in a position where markets are only really pricing in one rate cut for the entirety of this year. So could that limit the amount of upside that we're seeing? Let's see. Here we go. So that's it on the weekly time frame. So we've sort of been grinding lower, but during this period of rate cuts for the Fed, we haven't necessarily seen a huge amount of downside. So does that limit the upside as well? Yeah, time will tell. Really interesting one. Inflation data coming out this week, but really people care about what oil's doing and the impact that could have on inflation down the line. And of course, like I've shown you, that has implications for the likes of the US dollar, the bond markets, the likes of the S&P 500 and US equities as a whole. So I hope this has been useful. Make sure to like, subscribe and follow for more. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.